Hey everybody, Preston Brent here with our Trader Use Group. This is the weekly roundup for the week ending July 18th, 2014, an option expiration week. It's also the summer months. As you probably know, I didn't have a session or a weekly roundup this past week. And the last 2 weeks in August, I'm going to be finalizing vacation time and then first week in September after the Labor Day holidays here in the United States. We'll be back and at 'em again full time. So for now, what you see on the screen is the cash index, the S&P 500 SPX. I thought we'd take a step back just a little bit and take a look at kind of where we've been, where we're going, and where we can see some potential resistance and what can possibly happen. So looking at the SPX, I've got a monthly chart up here. And it's important that we do take steps back from time to time just to kind of get a gauge of what's going on. As you can see here, this was the peak back in the 2000 dot-com bubble, as it's infamously called here in the United States. And then we, pretty much gave it all up and had a pretty good little pullback. We gathered support, and then we ran all the way up until we had the 2007, 2008 financial crisis right here. You can see almost we made a little bit higher, but it was pretty much a pretty good solid sticking point. And then we gave it all up with the financial crisis, the mortgage crisis, and pretty much a global contagion as we had a very severe pullback. In fact, we pulled back further than we did during the dot-com bubble. And then March 6, 2009, to be exact, we pretty much just have been on steroids ever since, and then we have just really been shooting higher. Everybody keeps calling for a pullback of 10% or so, just to kind of keep people honest. I'm looking at all the TV talking heads, and it's really interesting. While everybody's been talking about pullback, the markets just keep marching higher. And a big part of this run right here, just understand the difference in this run right here and the difference in this run right here. It really is amazing. This is what the Fed can do, when they just really print unbridled money. All right. You can see right here that in this run right here, there was not the Fed's, swelling the balance sheets of the U.S. Government balance sheet. And in this area right here, that's what they did. We've expanded our balance sheets by over $4 trillion. Money is going to seek the highest yield for the lowest risk. And when the money has been flowing into the U.S. balance sheets like they have, U.S. government treasuries and so forth, it forces money into the equity markets, and this is what we get right here. And you can see that and the way it's been. Now, nobody knows what's going to happen when the Feds finally stop their stimulus every month. We're down to $35 billion a month now. And that Yellen has come out after Bernanke and said we're going to stop the purchases by October now of this year, taking another $10 billion off every month until we're finally through, and then we're going to let the markets run where they run. Although they have committed to keeping the interest rates artificially low for quite some time, probably into 2015, 2016. No one knows what's going to happen. I do believe, personally, that we're going to have a pretty good little pullback here when that happens, although I don't know the timing of when and how much of a pullback. The markets are fairly valued right now. We were undervalued as far as projected earnings in the S&P 500, but now we're just slightly overvalued from where we are right here. But you can see this is a key area right here on the charts with valuations. And this area right here is kind of what I guess many people would say it's the alpha. It's the market extension from all of this money that's been kind of running into the market. So if we're looking to do comparisons, we can say that, right around this area right here, which let's call it the S&P 1600 to the 1700 area. When the stimulus is removed from the market, and when the Feds pretty much let corporate earnings stand on their own, and they let the markets kind of go where they may, the question is, are we going to pull back, to this area right here? Of course, nobody knows, but we're going to be driven more so on earnings and more of a normalization of the markets rather than this fictitious thing that we've been seeing right now in the U.S. markets. And remember, um, the other thing that I want to point out here, and a lot of people may not be considering this in their evaluation of the markets, but the markets at this time right here and at this time right here are entirely different than they are here from a global perspective. Why? Because of technology. Technology has allowed all of you that are looking at this video now to, with the right platform, get in and out of markets globally. Get in and out of global currencies, get in and out of global markets, depending on the platform you have. Hedge funds can move in and out of any market across the planet, and they can hold asset classes, various sectors. They can hold sectors within the German markets, the British markets, the European markets, Australian, Chinese, South African, Brazilian markets, Canadian markets, in any currency they like. So what does that mean for us? Well, what that means is now going forward in time, we're going to be more affected by things that not only are just occurring in the U.S. markets, but are going to be occurring in European markets, in Asian markets, Latin American markets, more so than we were back over here and clearly over here. I remember times back over in here in the late 90s, you could hold IBM stock, you could hold other stock, and then, something could happen over in the European markets or Asian Pacific markets, and it really didn't affect U.S. equities as much. But as we move forward in time, everything is getting tightly wound together so that a contagion effect in countries that are very small over in Europe, like Portugal or other smaller countries making or missing bond default payments and things like that, can slowly contagion to a bigger global view via the ECB and then via Asian markets and via U.S. markets. So we're seeing a little bit of that happening over on this side of the equation that did not happen over there. So what that means is you got to be a smarter trader. Your market awareness has got to be more in tune with what's going on in global markets. Now, ever since I founded our user group, and by the way, I founded our user group back in this time frame right here. Actually, right in this area here is where I started our user group in September of 2008. And we've done very well. Now, we played this down move and we've played these up moves, and we've averaged a very good return for our members, members that are following us and following what I'm doing over these years. But as we go forward in time, we've always been very acutely aware of the global markets and playing global markets and how they interrelate to each other and where money is flowing both in and out of various sectors, out of various countries, whether it's emerging markets or it's U.S. markets or the ECB or Britain. And we've been doing this ever since we started, and we're going to continue to do this. And it's just, and if you're not doing this, as part of your trading plan going forward in time like this, then you're just, you're setting yourself up, I think, for some very unhappy times. All right. So having said that, I wanted to just kind of jump in and take a look at the SPX. You can see here that I've run a couple of key Fibonacci's from two key pivot points. You can see, and looking at these two key pivot points, I plotted some extensions, all right, off of the prior pivot low right there and the prior pivot high right there. These extensions on this monthly chart kind of give us an idea of where we can expect possible resistance. Right now, we're coming right up on this 50% extension off prior pivot highs right here from a prior pivot low. This is going to be a significant burden for us to overcome. Can we do it? Sure, anything can happen, but I think this is going to be a significant burden, and I think this is going to be an area where we're going to kind of hang up. I was telling our members in our chat room on Friday, and I was talking to, I hold a monthly meeting seminar, and I was also telling folks, would not surprise me to see us punch through 2,000 and then roll back a little bit. You can see this key area right there. I think that it's just slightly north of 1700. Um, I, I would not be surprised for us to visit this sometime before the end of the year. Keep in mind, we're going through July and August, so volume is very low um, until we get through the official start of the where all the traders are back from vacation, kids are in school, everything really starts to pick up, which is generally in the beginning of the September timeframe. And that leads us into October, which has traditionally been the worst trading month of the year before we get into the year end with, people with the markets moving up. Now, that's what's happened in the past, but you use the past as a guide, but we got to play the price action. So this is the monthly chart. You can see a couple of key pivots that I've got in there. Another one that I've got in there is 1849.44. So these are some key areas here, and they're really zones, give or take 10 points, where we can come to. Let's zoom in a little bit. I'm going to come into a weekly chart here. And as we zoom in a little bit tighter, you can see some of these key pivots starting to take on a little bit more meaning for you. Again, this very long pivot right here was done off the monthly. But you can see now on a weekly just how some of these pivots here are starting to take on a little bit more meaning. And I've got a Fibonacci extension within an extension here. So this red line that you see right here is the 50-point extension off a prior pivot low and a pivot high based on a monthly chart. Okay, and then you can see these extensions here, they're based on a daily chart. And you can see we're hung up right in that area there, which is right around a 200% extension off a daily chart. So we've got some areas of confluence here, or congruence rather, that making up my own words, that basically say we've got a lot of resistance in this zone here, a ton of resistance. Again, momentum may punch us through, and then we can roll back and test some support areas right here, and then a big support area I have at 1849.44. All right, so I'm watching this on the price action. If we take it down finally to the daily, you'll see what I mean. You can see, again, this is one of the areas of, this was drawn off of the daily right there. This one right here was drawn off the monthly. This is the big one right here. This is going to kind of be, well, let me just get the drawing tool right. This was the big monthly one. This was drawn off the weekly and the daily right here. But you can see this is kind of like the point of no return. It's kind of like a moat for us. Very big resistance here, or support area now. And then we got another minor support here, as I said, just slightly north of the 1700 area, around 1720, 1730 area. But then you can see I've got smaller pivots in here that were based on the daily. Right in this area here, and you can see where we're sitting right now. So if I blow this up just so that you can get a better view of it on your computer here, you can see where we're sitting. We are in this tight sandbox right here. This tight sandbox defines the current price action right in this area right here. And we're kind of sandwiched between these two pivots here, the 0.61 and the 200% area. And then we got a little minor 231% pivot off a daily, and then we got the major one right there that is the 50% pivot off the monthly. So we've got a ton, folks. We got a ton of resistance sitting there and sitting there, moving us up. I would, again, as I told our members, I wouldn't be surprised to see us hit the 2000 area because it is a psychological barrier. And then boom, we just roll right on back over. Would not be surprised to see that. But I want to see how the market action reacts. Remember, last week was option expiry. So in a normal week with option expiry, you have a decrease in vol and you have a slightly grind higher kind of mentality. Now we had a Thursday, Friday, which was very interesting. That Thursday, Friday gave us a big down day and then a big up day. You can see it gave us an inside day, which is traditional in a big down move and a big up move. What's an inside day? Well, you can see here that was Thursday, the high and the low, right? And this is Friday, the high and the low. And you can see we opened at the low and we closed right at the high. But it was an inside day to that prior bar there. So now the momentum finished us towards the upper part of the day. Are we going to be able to come up, take out the prior highs in the SPX of 1985.59? I'm going to be watching that. If we hit it and take it out, I think we'll do a quick run. The momentum will probably carry us up at least to the 2000 barrier there, and then sitting just north of that is a key pivot or a key resistance point. It's a daily Fibonacci extension, and then just sitting just slightly north of that, as I said, is the monthly pivot, which is going to be a huge barrier right there. All right, so this is kind of how I'm seeing the market right now. Let's see how the markets take off. Remember, last week we had bank and tech stocks kicking off some of the bigger technology moves and earnings plays. We're going to get more of the same this week. We got a lot more earnings coming out. Earnings are going to drive this up. There could be a little bit of a contagion effect if, based on the unfortunate and very sad incident of shooting down that civilian plane, if the U.S. and the European markets come out with much harder sanctions, the blowback will be a little bit of an economic downturn. We could probably expect to see that in the ECB, and then that may, push us back down to the lower end of our trading range right in this area here, which we've been in for a little bit of time. And actually, we've been in a little bit longer time, actually. We've kind of been in this sandbox, as I said, right there, going back to, the 18th of June. For over a month now, we've kind of been in this sandbox. So, that little contagion could put us back down in this area again. But we have been on a buy on the dip mentality for the entire year of 2013. And that's the way we've been playing it. So any move back down in this area, I would probably be more inclined to just, pick up some longs, but not very many. As I've told my members, I'm not all in right now. I'm playing the long side, and happily so, but we're not all in. We're keeping a lot of dry powder until we get a little bit more clarity on the Feds, and we get a little bit more clarity on the earnings. Now, keep in mind the Feds, the FOMC here in the U.S. is going to be holding their meeting the last week of July, so we're going to get more clarity on, just when are they going to start playing with interest rates. Bonds have stayed amazingly high right now, which have kept interest rates very low. We're going to watch that very carefully as well. So, folks, we got a lot of moving parts in the market. We got the FOMC coming up in 2 weeks. We're the smack dab in the middle of earnings. We're coming up to some key fib levels, key resistance areas. We're more than fairly valued in the S&P 500. Everybody keeps talking about a pullback. We haven't had a 10% pullback in quite some time. People want to see that. I think it'll make some of the bulls more comfortable. But there's still not a lot of money in the markets right now. A lot of people sitting on the sidelines. They've been on the sidelines since the March 9, 2009 uptick. So let's just kind of see how this thing is playing itself out. And we'll be watching this week. Again, for those of you that are not members of our group, we've added a monthly membership option. We've got semi-annual options. I'd encourage you to come to our website, click on our special offers button just below our video, and pick something that makes sense for you. We're growing very well. We're doing very well in the markets this year to date. At least the trades that I'm putting on that folks are following me on, we're up around 73% year to date. And we're having a good time. So I hope to see you, a lot of you guys check us out. But otherwise, for our weekly roundup, we'll be back at it again for this coming weekend. Have a great weekend, everybody, and I'll be in touch. For members, I'll see you tonight in our Secret Trader session, and we'll be talking about some specific actions coming up this week. All right, everybody, have a good one. Bye now.